In 2023 alone, the Social Security Administration issued overpayment notices to more than 1 million beneficiaries. The average amount they were asked to repay, over $8,000. Most of them had no idea anything was wrong until the money was already gone from their monthly. No announcement, no warning call, just a smaller number in their bank account, and a letter that arrived days later explaining why. This is and if you don't understand the specific mechanisms that can trigger a payment adjustment, you are not prepared for one. What we're covering today is the kind of information most people only find out about after it's already affected their payment. Signal exists specifically to get it to you before that happens. If you're not subscribed yet, do it now, because this video is one of several we've published on Social Security mechanics that most financial touch. Let's start with the assumption that gets most people into trouble. The assumption is that Social Security is fixed, that once you file, unless there's a formal cost of living adjustment once a year in January. That belief is understandable. It's also wrong. The reality is that the Social Security Administration manages benefit by your own life circumstances, some by data it receives from other federal agencies, triggered by internal review cycles that run on their own schedule. Any one of these can change what lands in your account this month without any prior warning, and in many cases, formal notice arriving before the adjustment has already been made. The Social Security Administration does have notification requirements, but the timing of those notifications, and the form they take, means that many people see the money change first, and the letter explaining it second. Sometimes with tight budget, that gap between the change and the explanation can create real financial stress. So let's break down what's actually happening here, starting with the most common and least understood of all the adjustment mechanisms. The Social Security Administration has the authority to withhold a portion of your monthly benefit to recover what it calls an overpayment. Occurs when the SSA determines, through internal records or data received from other agencies, that you were paid more than you were entitled to receive during a prior period. This can go back months or even years. And when the SSA makes this determination, it can begin recovering the overpayment by reducing your ongoing benefits, sometimes until the full amount is recovered. Here's what makes this particularly difficult to anticipate. The SSA's data matching systems run on ongoing cycles. They received earnings records from the IRS. They receive income data from state agencies. They cross-reference reported household situations. When any of that data doesn't match what was on file when your original benefit amount was calculated, a review can be triggered. And depending on what that review finds, a recovery action can receive a notice, but the notice may arrive around the same time as the first reduced payment, not well in advance of it. The default withholding rate for overpayment recovery used to be 10% of the monthly. Recent policy changes have adjusted how these rates are applied, and the SSA has gone through periods of both tightening and loosening its recovery based on congressional pressure and administrative direction. But the core authority to withhold remains intact. And for beneficiaries who aren't aware of it, a 10, 15, or even higher % reduction in a monthly payment can come as a serious surprise. Consider a realistic Margaret is 68 years old. She began receiving Social Security retirement benefits 2 years ago. Her monthly benefit is approximately $1,900. She also works part-time, earning well within what she believed were the allowable limits. What she didn't fully account for is that her earnings in one quarter of the prior year pushed her slightly over the annual earnings applied before she reached her full retirement age. That threshold is adjusted every year. She receives her earnings records from the IRS. Its systems flag the discrepancy. A determination is made that a modest overpayment. The SSA sends a notice explaining this, informing her it will begin recovering the amount through payment reductions. The notice arrives on next payment is direct deposited the following Wednesday. The first reduced payment comes through before she fully processes. Her payment that month is reduced by roughly $190. Bills auto-drafted from that account don't clear, leading none of this was fraud or malicious intent. Just an honest misunderstanding of an annual threshold not tracked closely enough. This scenario plays out quietly across thousands of households. Understanding the mechanics matters more than simply trusting that the number will stay. Now let's talk about Medicare Part B premiums. This is where things get quietly expensive, catching people completely off guard. Care beneficiaries have their Part B premium automatically deducted from Social Security. The standard premium adjusts. What they don't factor in is IRMAA, the income-related monthly adjustment amount. The income the SSA uses to calculate your IRMAA surcharge is not your income from this year. It's not even last year's. It's from a tax return filed 2 years ago. A home sale, large retirement, withdrawal, or capital gain. This could be quietly cutting your social security check today, and you might not connect the two events. Depending on your income bracket, that surcharge can run into hundreds of dollars per month, taken directly from the payment. Most people who get hit by this assume it's a mistake. It isn't. It's a rule that almost nobody. There is an appeal process for IRMAA, and specific life-changing events can qualify you for. People don't know this option exists, never pursue it, and simply absorb the reduction month after month. This is the layer of social security that most people never see until it costs them money. Staying informed is not optional if you want to protect what you've earned. Subsignal. We do this research so you don't have to spend hours decoding federal policy. Now let's go a layer deeper, because there are additional adjustment mechanisms less commonly discussed. One involves the Windfall elimination provision and the government pension offset. These rules reduce Social Security benefits for people who receive pensions from jobs not covered by Social Security. Certain state and local government positions fall into this category, where workers paid into a separate pension. The reductions are calculated based on pension amounts and benefit formulas that can shift. Pension amount changes, even due to a cost of living adjustment. It alters your Social Security. People can watch their Social Security payment move in response to changes inside a completely separate retirement. Another mechanism worth understanding involves what happens when a beneficiary's reported living situation changes. Supplemental Security Income (SSI) is particularly sensitive to this. SSI benefits are means tested and closely tied to household income, assets and living arrangements. If you receive SSI and move in with a family member, the SSI may determine you are receiving in this means food or shelter provided by someone else, and apply the 1/3 reduction rule, cutting your monthly benefit by roughly 1/3 until your living situation changes. The trigger for this review is often something as routine as a change of address or a mention from a household. Not realize the review has been initiated until the reduced payment has already arrived, and this connects directly to something that doesn't get nearly enough attention: the SSA's periodic redetermination. Every few years, the SSA conducts a formal review of eligibility for SSI recipients, examining income resources and living arrangements to confirm that the current benefit level is still accurate. That review finds your circumstances have changed, even in relatively minor ways. Your benefit adjusts accordingly. The SSA is required to notify you beforehand and request documentation, but the timeline can compress quickly, so adjustments arrive before you fully understand. Do with all this? The most important shift is mental. Stop thinking of your Social Security payment as a calculated output responding to specific inputs. Income, Medicare, pensions, living situation, work status, all are lined. Understand that, you stop being surprised and start being prepared. The most practical thing is to read your annual notices carefully. The SSA sends a benefit verification. These documents contain figures determining your payment, comparing them to what you receive, catches discrepancies before they come. SSI know what triggers redetermination. Organized income, lease, and household info means faster process. If an IRMAA affects your premium and income dropped since your last tax return, you may have grounds for appeal. A successful appeal can recover hundreds of dollars monthly from when it's granted. That's significant. You receive an overpayment notice and believe it's incorrect, or repayment causes hardship, you have the right to can waive overpayment recovery if you're not at fault or repayment causes hardship. These waivers are request them, but they exist because the system recognizes not every overpayment is the result of beneficiary. The underlying principle across all these situations is the same: engage rather than absorb. Say processes are largely automated systems do not self-correct on your behalf. They respond to input. A beneficiary who responds to notices requests clarification and understands options is in a different position than one who assumes adjustments are correct. Now let's talk about what's coming. The pattern over the next 12 to 18 months points in a clear direction. As Inspector General reported improper payments, including overpayments, represented billions. Response: the agency has steadily increased its focus on recovery. Overpayment detection has begun. Data matching pipelines between the SSA, IRS, and state agencies have expanded in scope. The agency has a strong institutional incentive to tighten enforcement, and the infrastructure to do it. What that means is the population of beneficiaries who receive an unexpected payment adjustment is not shrinking. More people will encounter these situations, not because rules are harsher, but because systems enforcing existing threshold violation that might have gone undetected 5 years ago is increasingly likely to be caught today. An income discrepancy that once took 2 years to surface may now serve beneficiaries who understand this landscape. It's not a threat. It's simply the new operating. The people most affected are those still assuming their payment is stable unless they hear otherwise. That assumption no longer reflects how these systems are not going to slow down. Data matching is improving every cycle. Overpayment recoveries beneficiaries caught off guard are almost always the ones who assumed their payment was set and stable. You now know it isn't. You know what triggers adjustments, what your rights are, and exactly what to do when knowledge is the difference between absorbing a hit and responding to one. If this video gave you clarity, share it with one person in your life who receives Social Security. We need the views, but because that person may not know any of this, and it could directly subscribe to Macro Signal. We publish breakdowns like this regularly on Social Security, Medicare, federal policy, and administrative. This is the kind of information that should be common knowledge. We're working on making it that way.